Good morning, everybody, and welcome to the second Sandcastles podcast. I'm honored today to be joined by an esteemed panel of guests, and I'll have them introduce themselves, starting off with Brad Bernstein.
Morning, everyone. I'm happy to be here with you. I run a private equity firm called FTV Capital. We focus on growth equity investing in financial services, enterprise tech, vertical software, and healthcare IT. We manage $10 billion and are looking for growth stage companies, typically 10, 20 million of ARR minimum before we get involved.
Excellent. Chris Lynch, can you introduce yourself?
Hi, I'm Chris Lynch. I'm the CEO of AtScale. We're the open semantic layer, and that's my day job. And my part-time job is I'm the founder of Reverb Ventures.
Excellent. Luis, can you introduce yourself, please?
Thank you. My name is Luis Valdich, and I recently started a venture capital firm called VIM Investors. Our initial focus is on doing secondaries in scale-ups, in late-stage companies in areas where I've invested before. I used to be at Citi Ventures, JP Morgan, and SoftBank. So that's fintech and financial services relevant enterprise software and applied AI, Gen AI, companies with 100 million to $1 billion in revenue, still growing very fast, with either profitability or a fully funded model. Great to be here.
Very good. And Chris?
Hi, Chris Conde. Thank you very much, Andy, for doing this. I started my own company with two other guys, and we sold it to SunGard, which was then a small company. I ran SunGard for 12 years, and together with an amazing team, we turned it into a Fortune 500 tech company.
Excellent. I think everyone on the panel has something in common, which is we're all operators. We like building stuff, and we like working with people who like building stuff. But finding the right stuff, finding the right companies, and finding the right people to build those companies can be really tricky, particularly when you're looking to scale up. Maybe Chris Conde, since you've done it yourself in a company, why don't you start and tell us what you think are the secret ingredients in finding the right people and finding the right companies when you need to scale up?
Well, I mean, part of being a scale-up is that you do have an idea of what skills you're looking for, but I think what has worked the best for me, at least, is that to look for people that have fundamental curiosity and are interested in learning. Then the details they will always learn. But at different stages, they call for different types of people. And always, if you have to upgrade your team, look for somebody that has done something bigger. You know, that always is better.
Yeah, no, definitely true. Brad, you've got more experience than anyone else on this call doing this across a whole range of different kinds of companies. Can you share with us kind of your secret sauce in terms of what people you're looking for and kind of specifically what type of companies and attributes of those companies really are the key to unlocking the door to the vaults that are full of FTV's funding?
Sure. Well, there's two big questions you just asked there. There's what do we look for in the company, and what do we look for in the leadership and the people in terms of how they're going to execute? And obviously, one of the nice things about being a growth investor is we're looking for companies that have already established a level of success where they've proven out the market, the product, the unit economics, that the management team is working reasonably well to achieve some strong growth metrics. And so that takes a lot of the risks out of it. But to the whole point of this podcast today, it's all about how are you going to scale it? How are you going to execute on scaling it to the next level? And I think, one of my top things that Chris said is the whole point of having a founder or leader who's kind of willing to acknowledge what they don't know and is truly interested in getting the input on how to evolve the company to take advantage of the opportunity. And of course, what we look for is the kind of KPIs, OKRs, the metrics, the framework for kind of tracking whether the machine is set up to scale and whether we can use those metrics to orchestrate and understand, are we succeeding? What investments do we need to make? How are we going to track success and failure on those metrics? And then I think ultimately, and I'm really interested to hear what the other folks think on this, it comes down to people And it's so hard for founders, especially first-time founders who have loyalty to their team, to open their mind to the reality that the people who got you here may not be the right people to get you there. And so there's going to be a real hard part of the process of upgrading talent, bringing in people who have seen scale to help you in that next stage. Let me leave it there.
Well, Chris Lynch, I mean, you've inherited a number of companies exactly at that stage and had to figure out how to scale them, as well as starting some from scratch yourself, but also you've invested in many of those in your investment career too. Could you share your insight? The insight that you shared with me when I founded Santal East is time is the only thing you can manage. And I've really tried to live by that. And clearly when you're trying to scale a company, time is essentially related directly to runway, and runway is related to how long you've got left to do what you promised to do, as Brad just described from a metrics perspective. So let us into your mind and let us know how you think a bit about that.
Well, as you know, Andy, we got introduced as you being a customer, me being a salesman. And there's a saying in sales, time kills all deals. And if you think about the landscape today in AI, it kills everything. So we're working at a speed of change that's unprecedented. So you need to be able to, you need people around you that are going to be decisive, that can fail fast, can own those failures, right, and recover from them and move. And I think we're in a world where everything's an experiment, and we're continuing a cycle of experimentation as we're trying to get traction in these companies. And the landscape is, if you think about what's happened, you know, in the last 6 months, last 12 months, the advent of agentic AI and how it's dominating the thoughts of people and what's happening in the world today. So I think it's even more taxing for people going forward in 2025. When you think about, you've got to walk and chew bubblegum, meaning you probably saw recently that Microsoft laid off another 10,000 employees. It's with the presumption that they're going to get these gains with leveraging AI. Excuse me. I think one of the things that people are going to have to recognize, the people that I hire and I invest in, having a working understanding, whatever your job function is in a startup or a growth stage company, having some level of AI capability is going to be the equivalent of literacy, meaning it's your responsibility, right, to come into a job and be able to speak English, right, and function in your role and be able to read and write. If you don't have that level of proficiency with AI and AI tools, you're going to be in deep trouble. And I think that people that can't embrace that are going to have trouble in the market, and they're going to have trouble very quickly. And I think Chris mentioned it. You know, one of the attributes that I always look for is intellectual curiosity. And if you think about what's happening in the world, if you don't have that kind of discipline that you're going to double click on things and learn in real time as things are changing, you know, you're going to be lost.
Very good. I mean, I with all 5 of my kids, I've told them you should assume that anything you know now will be worthless in 3 years' time. So continuous learning is like super important. Obviously, the way a corporate like Citi or JP Morgan, Luis, looks at an investment is very different than the way investors like Chris and Brad have done so. When you were making investments from Citi and JP, what were the things you looked for, particularly when you were going in alongside one of these guys, and maybe when you were going in as a lead as well?
Yeah, I'd say that some corporates have a very different way of looking at investments. I think that in my case, I actually tried to have more of a similar mindset to some of the people in this room, and certainly think about those attributes of what exciting, distinctive founders have in companies that can go the distance and go public or be multi-billion-dollar outcomes. But in addition to what's being mentioned, and I definitely want to overemphasize the growth mindset that was talked about, the culture of experimentation, ownership, accountability, adaptability, learning agility. what large corporates are very keen on, not only from an investment standpoint, but certainly from a partnering standpoint, is resilience, robustness, security, that the partner that they're going to embrace is really built for becoming a very robust organization, ideally one with which they will not only partner on a point solution, but ideally do more. And probably Chris Conde can tell us great stories about the great success he had cross-selling Sangha products throughout the entities where he had gone in initially with a single product. So that's, I think, a very important, aspect of what large corporates look at. And a partnership mindset is also very important, as many times, very large, complex organizations may need to provide input on the product roadmap and look for enhancements that perhaps were not on the near-term roadmap, but finding that sweet spot of adapting and partnering without losing the North Star and the true focus is a very important aspect of how to handle some of that input, and also without being overwhelmed and being turned into a services company, which can always be a risk, particularly for those that are at earlier stages of their journey.
Yeah, we've seen many companies morph their product into a product they sell to only one company. So totally understand that. I think maybe we could just double click a bit on what growth mindset actually means. And in practice, we talked in our pre-meeting a bit about kind of a company that operates like a machine, where you can add more fuel to the machine and the machine itself turns out more output as a result of that. And Brad, when you're looking for that attribute, when you're looking for can it scale, can you talk about kind of what you're looking for, and also how you figure out what quantum of capital makes sense to put into a company based on what you see? Can you just kind of touch on that?
Well, obviously, for all of these companies, you're going to be studying the analytic with as much analytical horsepower as you can, the entire go-to-market workflow, from lead generation all the way through each segment of the funnel, sales cycle, and funnel to getting deals closed. And the more a company is measuring those various components and has clarity on where they need investment and what the productivity of the investment is at each stage in that process, the better. And so we really want to see that as first and foremost critical, so that we can be thinking about the sales expenditure and how sales and marketing is going to drive growth. And then, of course, we're all obsessed with retention. What is the level of customer retention? Because the return on that sales dollar is going to be directly correlated to how long that customer sticks around. And the higher that retention, the more resilient the business is going to be, the stickier it implies that the solution is. And of course, the better the ROI on the investment in sales and marketing. So really understanding both your gross and net retention, the ability to upsell those customers, how that's working within your existing customer base is a really important part of the program as well. And typically, if you have all that working well, that's going to be a really, really good sign. And of course, we're always sensitive to how much burn the company has. So there's a limit there, but the better the ROI on that sales and marketing spend, the better the long-term prospects for investments are going to be.
Very good. One thing that I've always thought investing alongside FTV and with you, Chris Lynch, is that I like the way you think about trades. Like, you're not marrying the company, you're working with the company to take them from here to here. And the implication of that is that you've kind of decided, hey, this company can definitely grow by 2.5 to 5x, maybe, to use Brad's catchphrase. And I've seen you, Chris Lynch, go into companies and trade them very quickly when they've grown really fast because you've already made the return you wanted to make. But I've also seen you as an operator go in there, be gritty, and absolutely drive them. So when you're trying to drive this from an operator perspective, but someone who's been an investor as well, and you know what it's like, the other people sitting on your board, how do you take what Brad said and turn that into a dashboard or something visual that they can get their head around? And what do you think are the important metrics? He's talked about NRR, obviously, churn, and so on. But how do you think about that?
So I'm more simplistic than Brad, but I think the concept is similar. Everything I focus on, and obviously I focus on more early stage things, but I look at makers and sellers, and I don't see anyone else. And then behind that, I see a model, right, which is every dollar I put in, I want to understand how many dollars I get back. And we talked about, or Brad talked about, like, what are the unit economics? At the end of the day, you have to invest behind revenue. When you invest in front of it, you get in trouble. And every business that I try to build, I'll continue to invest behind that business, my time and my money, if I see the model or I see the model developing into one where I can create visibility and linearity, because that's a business even a dummy like me can run. But if you don't have visibility and you don't have linearity, then you better have scarcity value. And as you know, if I don't have the other two, then I sell the companies based on scarcity value, and I sell the asset to someone that has that model built, that can take the technology and put it into some sort of situation where $1 in yields $5 back or whatever that is. But it's about driving those unit economics and just eliminating all the subterfuge that's around these companies. At the end of the day, those are the fundamentals that you're going to ultimately invest in or not. And if you don't see a path to that linearity, to that visibility, then there's really no way to run the company with precision. So then I'm looking for, how do I combine this asset with another asset someone else has to solve that problem, and sell it into a channel that's maybe more mature, or has got a customer base that they're strong enough in that they can take and do what we couldn't do, from a business
kind of like
perspective.
what you did at Data Robot then with Newtonian, that kind of idea.
Yes.
Makes sense. Chris Conde, you have a reputation for, applying a growth mindset regardless of the scale of the company and being able to focus on the detail, including as a CEO, from what I remember, even doing code reviews as a CEO. Very few CEOs have done that. Can you talk about how to spend your time as a growth CEO, and it could be even in a public company, and why you thought things like looking at code were important, which I 100% agree with, by the way. But just give a perspective into how Chris thinks about doing that, because I think that would be helpful.
Every job function has a defined schedule, like a cadence of events. If you're running sales, you have a quarterly business reviews, you have monthly reviews, you have this, you have that. And when you are running engineering, you have code shipping schedules. When you're a CEO, none of those schedules apply, and it's really the only job where you get to define your own schedule. But part of it has to start with a sense of humility that the best ideas are not going to be your ideas anymore, that the best sales are going to be the ones that actually didn't involve you at all. So how do you spend your time? What you can do as a CEO is to remove impediments. Take a look at where the friction is inside a company and what is the key impediment that you can remove, because there's many impediments that only a CEO can remove. Sometimes the biggest impediment is incompatible code or code that is just being developed in a wrong way. That calls for code review, but usually it doesn't. But I think certain humility in the CEO. Where can I make the biggest impact? That tends to be in removing impediments to growth as opposed to in idea generation.
Very good. Very good. In terms of this kind of growth mindset, Luis, and just the founding of your new company, VIM, I mean, there are many, many growth equity companies. that are in a position where it's difficult to exit unless you can do what Chris did, which is to combine companies together to get more scale to go after the market. How does that play into the thesis for the founding of VIM, which is a secondary equity offering company, essentially?
Yeah, no, thanks. It's a great question. The way that I am thinking about it is to pick companies that are already winners, that have scale, that are still growing very rapidly, where it is differentiated, etc., very strong teams, and where because of idiosyncratic market reasons that exit has not happened yet, and thus the value we're providing is to those whether it's early investors or founders, employees, or maybe corporates who had strategy that changed, whereby the investment's no longer strategic, that are, because of their own personal reasons, interested in getting liquidity now versus in the 2 or 3 years that may take for the natural exit to eventually happen. And there is such an abundance of really quality companies that where these circumstances are there. As you know, other than earlier this year, the IPO window, opening, it's been since 21, pretty quiet. And frankly, there was an exuberance of investment, and as a result, sometimes not the very best, spending decisions were made, etc. But that all has come to pass, and we are, finding exceptional companies where we can step in and provide that liquidity, and at the margin, we can try and use, our networks, including with folks like in the room and other corporates, to try to also be a value add investor. But in a sense, we're really focusing on picking companies that on their own right are just doing very well.
I mean, it seems to us at Sandcastles that the whole private credit and private equity markets are morphing to become more like the traded markets. You just look at what the announcements from NASDAQ private market. You think about the role of Thoma Bravo and some of the much bigger PE companies, and the issue you described, which is almost the frozen nature of companies who are growing really effectively, but there's no easy exit path. I think all of those things play together to say that maybe they should just have more longevity. And I think what you're providing is a capability to allow people to continue to do that, oftentimes when they need money to send kids to college or whatever the liquidity reason is. So I think that's a good service. And I also think that the ecosystem by 2030 will look very similar on the private side to the way it looks on the public side, to be honest.
Absolutely. And to add to that, Andy, spot on, two quick things. One, that venture investors themselves, in many cases, need to show DPI in order to raise the next fund. So even institutional investors, have that dire need for liquidity. And the last observation, very much along the lines of what you're saying, is that in the private equity, in the buyouts world, secondaries has been a significant asset class for a long time, and a meaningful percentage of exits in private equity are selling in secondaries. But when you look at those statistics in venture-backed companies, and when you exclude the OpenAIs and the likes of the world, the top 30 or so darlings, it is incredibly small, the extent of secondary activity relative to primary investment dollars.
Very good. Great discussion. One of the things,
just on that point, I just, if I can keep that discussion going for a second, I think one of the fascinating aspects about this is that the public market is not serving sub $5 billion market cap companies. So the bar for going public has been raised to a pretty high level. Companies that used to go public and have fantastic performance in the public market at billion-dollar valuations are just no longer finding a receptive audience in a market of passive investing ETFs. It's just not fitting in, and less active asset mutual fund managers as well. So when you look at the ecosystem, what it's doing is the venture has always relied on those high price IPOs and strategic buyers to kind of pay big prices for sexy emerging companies. And both of those markets have really changed and aren't really available. So what's fascinating right now is venture needs to turn towards growth equity, PE equity as probably the most viable exit, and of course secondaries. But the valuation fundamentals have to be there for sophisticated private equity buyers. And there needs to be an evolution the way venture and founders are thinking about exit and realistic economics for the next owner in a world where you can't rely on some crazy price from a strategic buyer or some crazy IPO valuation. So that's going to be an interesting, I think, an interesting evolution of venture and how that's going to think about exits in the near term.
And if I may, Andy, I'm sorry for taking out of this because I 100% agree with what Ben said, and what I would add is that and coming back to AI will be an extremely important element in helping these scaled companies substantially improve their economics, so that when some of those potential exits happen and are priced less of revenue and more of EBITDA, the math can still end up in a very compelling exit. So the importance for AI for scale ups, back to the core of the conversation, is even accentuated by that trend that we're all highlighting.
So maybe let's just drill into that a little bit then, because it's clear to us that data moats and the scale of data moats and the ability to combine proprietary data with public data has become extraordinarily important. Both of the Chris's have bet on that, both with their own careers, the things they've been CEOs of, the thing that Chris Lynch is running right now. And maybe to start with Chris Conde, because SunGard was really an analytics company at many levels, right? Different kinds of analytics, but an analytics company. And analytics has obviously become a vertical almost in its own right at this point. When you think about kind of future value of companies that do have data and maybe are stuck in this middle earth of not being able to get out yet, one thing that I've seen the other Chris do is literally morph those companies into AI companies. I mean, it's a trick, right? I mean, they've got the data. What they need to do is figure out how to use that data to change the valuation and probably the margin as well, Luis, to your point. So maybe start with Chris Conde and I'll move to Chris Lynch. Just on that point specifically, How do you think about that?
Well, look, to use a baseball analogy, if the incumbents are already in the second inning, maybe the third inning, versus a startup, and they're in the third inning because they have the data, and they have data that is not public. So every advantage is with the incumbents. The problem is, do they have the mindset that Chris Lynch talked about? Do they have the mindset to explore and start monetizing the data in ways that were never thought possible? I look for creativity on the business model side to look for ways of monetizing data. Sometimes it's by outright selling the insights of the data. Sometimes it's by shared infrastructures and shared utility models where the industry at large shares data, and then the company gets to sell insights based on the blended data. So I mean, all of these things are possible, but it starts out with a growth mindset and seeing the data moat as an advantage that will erode over time and rather quickly, actually. So it's really important to get in front of it.
So I mean, I often think of the analogy between BI and AI, Chris Lynch. So if you think about Tableau and you think about Cognos and Hyperion, at some point, Oracle and SAP had to buy those companies, right? Because and to Chris Conde's point, the companies that are maybe too big to be able to swivel their tanker on a dime to be able to take advantage, presumably are going to have to do M&A. So maybe just give us your sense on that, because AtScale's right in the lens of those kind of companies, I would think.
Sure. Well, AtScale's kind of like the leisure suit. It's now back in fashion, right? So semantic layers have been around a long time. So the way I think about it and the way that I invest in the things that I'm involved in, I have a lot of sayings. One of them is, it's about the data, stupid. It's about the data, stupid. I think that every industry, every company that's going to survive has to figure out that it's cliche to say, oh, our people are our most important asset. The data you have and the data you can leverage to get more data and productize that data, those are the businesses. So if you think about, a great analog is, look what's happening with the social media companies, and they're moving into financial services, right? And they've moved into, if you look at Amazon as, right, the classic example, right? Look at all the businesses they've entered into by being able to leverage the data that they've accumulated in their core business, right? I think everybody, if you look at some of the acquisitions, Recorded Future, being bought by a bank, right? It's showing what's going to happen. The consolidation is going to be, everyone is going to understand that the crown jewel is their data, and they have to figure out new and innovative ways to productize that, because that's going to be their core asset. And as Chris mentioned, these are all business models that have to be invented in this new paradigm, and that's going to require new thinking, experimentation, and people that are bold and not afraid to fail.
Excellent. I mean, just thinking back to Gutenberg for a second with Chris Lynch's answer there, Brad, in terms of information arbitrage. If you can't have access to the Bible, you obviously can't read it. And you think about Calvin, you think about, what happened when all of a sudden there was access to Bibles. If our listeners haven't done this before, New York Library, they literally have one of the copies. You can go and see it yourself. I mean, it's insane. They actually have they have the entire works of Shakespeare from Gutenberg as well. And Gutenberg opened up a complete access to information and knowledge that people had not had before. The internet has done the same thing. And now AI is doing the same thing again. But I was at a presentation in Vegas earlier this year where Jay Chowdhury was keynoting actually at the Zenith Live conference. And he showed this slide which showed that actually AI and the Industrial Revolution are the two things that are alike. And the Industrial Revolution was based on access to information. The more people that had access to information, the more automation you saw. But also in that era, it took a heck of a long time, nearly 150 years, really, to end. But the last 10 years is where all the companies went out of business, because they were able to survive with the old model until really close to the end, because it wasn't so competitive. It wasn't so much mobility and so on and so forth. There weren't many people in the steam engine business, and so on and so forth. So when you think about kind of how fast the things are going to emerge in the next, say, 5 years, Brad, which is pretty close to your investing horizon. I mean, it's between 5 and 10, right? But the change that Chris Lynch just talked about is happening now. And the point he made before about people who know AI being able to do the job better than someone who doesn't know AI, maybe those people themselves have to rethink their careers. So just the way you think about that from making an investment perspective right now, how do you think about that?
So first of all, it's interesting. I would say we are spending an enormous amount of time making sure that our new investments have truly defendable moats relative to AI. So we're willing to pay a huge premium for businesses that we are confident have resiliency and cannot be undermined by AI. Of course, there's always going to be ways that AI can enhance or add value, but to the point that Chris was making, I agree with him. It's all data is one of the best modes. There are others. There are other reasons why you might have a two-sided market model where the market, the network effect of the model cannot be sort of undermined. You may have other kind of capabilities or certifications that need to be provided that AI can't just do the certification process. So there are examples where, and that's critical to us when we think about where we want to invest. I think my view is that AI is going to commoditize relatively quickly, and that you're not going to get a big margin gain because all your competitors are going to have AI too. And in fact, we've seen businesses where there's 20 new AI vendors trying to attack an established business that has a lot of people. And what our customers tell us is, first of all, they have vendor overload, the vendor fatigue, and they can't figure out one from the other. And they say, actually, we can't go with an AI solution that doesn't also have people for level 2 service, level 2 support. And so weirdly, the differentiator is the people layer, is the value add of having the people to put on top of the AI. So I think it's going to be interesting how it's going to evolve. I don't think that it's going to be easy to have excess margins because you've implemented AI for long, because I think all your competitors will do the same. And I think ultimately it's going to be things other than the AI that will differentiate you. So whether it's the data or the quality of your people or your customer service or other critical aspects that are going to really come to play here in that process.
Yeah, I mean, perhaps one way to say it slightly differently would be that the people that implement AI well will do what you just said. The ones that actually don't treat it well or come to it too late are the ones that are going to end up like the companies at the end of the Industrial Revolution, because once you've lost in terms of the ground that you've lost and the time, to go back to the point about time is the only thing you can manage, it may not be possible to catch up. So you just think about Netflix, you think about Netflix and Blockbuster or any of those kind of things, any of the Innovator's Dilemma things, at some point, which, Malcolm Gladwell says is 17% of the market, you hit the tipping point. And it's like BlackBerry, that's another good example. Mm-hmm. Once you get past the tipping point, it's very hard to get back into the game.
Well, AI is going to be an equalizer, is the way I view it. So it's table stakes. To Brad's point,
exactly.
If you're not there, you're not going to be in the game at all. And it's not going to take 100 years, Andy. No. You're going to see every year, based on what's happening, you're going to see the equivalent of Betamax to VHS. Industries, businesses are going to be disrupted annually based on leveraging this technology and the speed of the innovation. The data, right, is one component. It's how you're going to use it to reinvent yourself and reinvent your company. And if you don't figure that out, you're going to have a problem. And I think the people that are well trained and have all the attributes that Chris was describing and the teams he's built, those are the people that are going to win. It's domain expertise tied to all this new data and tools to understand it. Because the challenge with all this data is, how do you glean the signal from the noise? And those are the places where I'm investing. Like AtScale, we can provide context to data and these AI models and this agentic driven strategy, right? It's all data driven. You need data and context to get accuracy, to build the kind of new businesses that you can invent. Smart people, creative people that are willing to take chances are going to invent in their current businesses, which means they may disrupt them. One great example is, we've got a lot of customers that are in the retail business, manufacturing business, that are leveraging our technology for data, right? And that data is to optimize their supply chain, and they're selling that data to their suppliers, so their suppliers can be more efficient, more cost effective. Mm-hmm. But they're selling the data so that they can sell them their components cheaper.
Yep.
And these are not people that you would think are like leading innovators. Like what retailers are doing, manufacturers are doing, as they're able to really look at this data in a different way. and use it to predict. It's amazing what they're doing, and they're transforming their businesses. So they're actually selling data, right, to make their business more efficient. And I think you're going to see more and more of that kind of happening cross-functional.
I agree. I mean, if you go back and look at Walmart back in the day, this was one of Walmart's biggest strengths. They were really, really good at supply chain. And if you think about what Amazon's done, to the point earlier about expanding across data silos, they've done the same thing, and kind of, I would say, forced Walmart to buy Jet in order to be able to compete, because you have to have online to be able to compete. And it turns out you not just have to have online, you have to have bricks and clicks, I think, in that case. And I think that same thing is probably true with AI versus, let's say, traditional business. And so, you know, Chris, if you think about the models evolving and the fact that Walmart had to buy Jet to be able to compete, presumably the outcome of what Brad and Chris just said is there's going to be a ton of M&A of early stage AI companies with some knowledge in the vertical domain by the vertical domain owners who have enough revenue to be able to justify it. But there's a time scale there, isn't there, as well?
For sure. I mean, this is. I think I want to agree with what Chris said and Brad, but also Luis earlier. You know, when this growth mindset is so fundamental, because when you invest in a startup and it's now a scale up, the CEO has to understand that he or she isn't just the custodian of some franchise, overlooking a business model that was the business model that you invested in. No, it's simply a question of how did we invested in you because you were relevant then. How are you relevant now? Without doing all the things that Chris and Brad and Luis have been talking about, you're not going to be relevant. And so we invested in your relevancy. And what are you doing to keep that up to date? If you're not leveraging data, if you're not leveraging AI, if you're not just reinventing these things, you're just not going to make it. And you're not going to be attractive to a potential acquirer.
So, I worked for David Riley at Credit Suisse, and one of the things David always said is, in order to succeed, you have to be carried on the shoulders of giants. And by that, he meant you have to hire people smarter than you to work for you. Now, in some cases, AI is inside IT organizations. This is true in product organizations, also in mid-stage companies. And in some cases, like at JP Morgan, as an example, Jamie has moved that so that it reports directly to him. When we think about AI's impact on a growth business in the way that we've been discussing, and how important it is for the CEO and the executive team to be participating in understanding the capabilities AI can bring and why they should allocate capital, to precious capital, by the way, to making sure that they've got at least the basis covered and maybe even the ability to turn that into an advantage. Who'd like to start on that thinking? How do you have the conversation about budget and how much you allocate to what is probably out of line in terms of last year's or the year before's business plan as an item that didn't even appear? It's like cyber; it just kind of grew from somewhere, right?
Maybe I can get that started on that, Andy, and also add some very interesting dynamic as it relates to large incumbents versus scale-ups and startups. But in my mind, you kind of need a combination of what Jamie's doing, but also, and by that I would mean perhaps creating a center of excellence and some focused organization that's very much thinking about the applicability, both opportunities and threats that AI poses to all aspects of the business. But I also believe it's important to embed that AI thinking across the organization, and not only in technology, frankly, everywhere, because what's fascinating about AI is how it can touch on every aspect of an organization, from the production to sales to go-to-market to admin, finance, across literally all of the aspects. And the interesting dynamic that I think scale-ups face is that if you think about any space, you will typically see a market structure that includes incumbents, these scale-ups and the younger startups coming through. And in general, I'd say that the startups are the most likely to be AI native, and the incumbents are most likely to have the strongest data moats to what we were discussing earlier. And thus, the challenge and opportunity for the scale up is that they have arguably a lot more data to leverage than the startup, but much less than the incumbent. But they can potentially be a lot nimbler at experimenting and adopting AI to fend themselves better. So it becomes a bit of an execution game where they need to focus on leveraging it as quickly as they can, so that, for those incumbents that are asleep at the wheel and are not really embracing AI as they should, that is the opportunity they can jump into, and in that way to protect themselves from the startups that are coming after them. But I'll pause with that.
Okay, Brad?
Yeah, I mean, look, I think, I'm definitely a believer that, first of all, that, plans are useful, but planning is essential. And so there's the whole process of lots of planning and having that dialogue between investor and companies around the investments that need to be made and how to manage that is a critical process, even if you're in a dynamic environment. I really like to see a lot of thought about, tell me where you're going and how you're going to get there. I think one of the things we're seeing, just in terms of this, coming back to the AI point, is one of the biggest issues we're seeing is pricing, because AI changes the whole economic model of the value proposition. We talked earlier about time, and the reality is our whole world has been, for the most part, built around the hourly wage, the hourly unit of value add. And in a world where you have agentic, processes and AI doing the job for you, a lot of that whole system of thinking about value has changed. So pricing is going to be a critical question, or units of economic value add are going to be a critical question that has to be thought through. And what is the sharing of the gains from innovation as we work with clients in a way that's both equitable and competitive for the client, and equitable and makes sense for the company. So that's going to be a really interesting part of the equation. But I think that we really like to see a bottom-up planning process from the companies we work with that really shows the thoughtfulness of each of the departments and functions, but also has top-down goals and aspirations where we can triangulate and make sure those things come together and synthesize as we think about investing and planning.
Very good. Chris, do you want to add to that? Then?
Yeah, I feel, if you have to have a separate department doing AI, then you've really lost the thread here. You've completely, and you want people around you that just instead of giving you a finished product, that you won't believe what we managed to do with AI, and they start bragging, and they spent the whole weekend looking at this. Take a look at this, Chris. This is just so freaking amazing. That's when you know you have the right team. When people are coming to you, seeing AI as just something that is full of possibility, and it's that's what you need now. AI can't be
100% agree. It can't be a sidecar.
Yeah.
One, it'll take too long, and it's got to be internally embraced by the organization, because they have to see the world differently, right? And they have to be contemplating these tools that exist, right, and applying it, right, to their business, and they don't leveraging their domain expertise.
They need to show their excitement. You need to be able to. It has to be palpable excitement, like they are standing on the brink of a new world, and then you've got the right team.
And maybe just I couldn't agree more with that. I think figuring out how to enthuse people by showing them the art of the possible is absolutely a part of that as well. Sometimes it's like a tool my kids are using, not something that I've actually played with myself, and encouraging people to spend enough time to do that. Obviously, intellectually curious people do that naturally. Other people might need to be helped with that, I think, a bit as well. But maybe just to go back to Brad's point for 1 second on pricing and how to price and what the unit of measure is. That seems like a very important topic to me. We spend a ton of time on that at Sandhill East. I mean, we have everything from what I'd call labor arbitrage 2.0, where you're essentially selling agents as virtual workers, Brad, and you're pricing accordingly. So it's like a 20% of the cost of what the human would cost, basically, is one example. But the thing that I've seen be really successful so far is where someone says, I'm doing a strategic partnership with blah. So like we have an example of a large airline that has done a deal with one of our companies, and they said, we're going to be a strategic partner of this company. And that it sends shivers down the spine of some people who worked in financial services, that term strategic partnership. I think a strategic partnership where you have joint economics based on the outcome that you've decided to deliver together, and you're able to bring the expertise on the one hand to a company that maybe doesn't have the expertise to be as agile as some of the discussion we've had today, has been super successful. So, I mean, the investment bank that's made the most progress on cloud, for example, is the one that directly partnered with the CEO of Microsoft to do it. And they meet every month and they go through the plan. And this is back to Brad's point on planning. So I do think that the AI expertise within a domain and companies that are good at that and can bring that can actually get shared economics in a way that they've never had before. They've been more like paid by the hour. And this is true also for the entire consulting industry as well. So that topic, I think, is super, super important. And we will definitely see a lot more activity on that. Does anyone else want to comment on that before I move to the final set of topics? Okie doke. Well, let's talk about exit opportunities. So we've touched on pretty much everything else I think we had planned to touch on. We've said that there are a number of companies that are privately funded that are in a position where they're still burning cash and they don't have an easy exit. And to the point about the IPO window having been closed for a while, and the need potentially for more longevity in private companies. When we think about exit opportunities and we think about founders who are quite happy kind of doing what they're doing every day, Brad talked earlier about the hard thing about hard things and kind of, do you have the right people in the company to drive it to the next level? And, every startup that we've worked with at every level, all the way to even public companies, I mean, there's a level of sprint associated with getting to each target, 10 million ARR, 20 million, 50 million, whatever it is. And that can be quite tiring, right? I mean, founders at some point, want to go on vacation, want to do the things that they haven't been able to do. So maybe when we think about that, like how do we get a solution for companies where they are good companies, they are continuing to grow, they are burning cash? How do we think that we should think about exit opportunities? Should the founders be out there looking at those? Should the leadership team? Should there be a corporate development function in a mid-stage company? Should the PE company be actually looking at this all the time, scanning the landscape and so on and so forth? How do we think that should look? Maybe Chris Conde, why don't you start? Because you're the maven of fintech investing. So,
I last month announced the 98th and 99th M&A transaction that I've been involved in. So that's which I happen to like M&A. I mean, obviously, I wouldn't have done 99 if I didn't like it. But I think the key thing in M&A is really has not changed one bit, which is how do you? I think founders should be spending 1% of their time thinking of who is the likely acquirer, who would, and more importantly, who would absolutely hate it if the asset traded away to somebody else. And then you start developing those relationships and you work towards that. And these things, I mean, really successful M&A takes a very long time of getting to know each other. And sometimes, it can take years and years and years. But it's at the end of the day, there's just many, many bigger companies that are looking at M&A as a outsourced R&D. So you have to have enough technical, be ahead on the technology side. The use of AI, just show excitement around it. I mean, all these things are very fundamental. But at the end of the day, good prices are the product of FOMO more than anything else.
Yeah, I mean, you have to be appealing. I agree. Chris Lynch?
So from my perspective, I think you always have to have that vision of where you fit in the ecosystem and who wins or loses based on how you execute. And I think that's the leadership's responsibility to be aware of it, or the CEO, the leader. That said, I think companies, in my experience, they're bought, not sold. So you need to be focused on building a business, sensitive to who wins or loses and how you develop those relationships with companies. But I think you need to be building an independent business. And in my experience, if you do that, you build a good business, someone will come and make you an offer you can't refuse. You can't manufacture that. And I see a lot of companies that make the mistake of, they basically are building a company to be product line extension of, a potential acquirer, a set of acquirers, and things happen in the market. They may develop that technology. They may buy another company that's far less expensive, etc. So I think there's no substitute for just building a great business. And when you're building a great business, from my perspective, the people I invest in, what I try to do is ultimately, I want my customers to finance the operation, not my investors, right? And I see that from both sides of the table. When I'm investing in a company, ultimately, I want to see a path that company is going to be basically sustainable on non-dilutive capital, which is, customer orders. And I think if you track toward that, then they're going to come to you.
Brad, 1 minute.
Sure. Just to wrap up, I mean, look, the one thing I would say is that the process of selling in today's environment is both art and science. There's an enormous amount that you can do to improve your outcome by managing the process well in advance of actually having it. And so building relationships with strategic buyers takes a lot of time. Establishing trust, establishing the idea that you would fit in their culture or organization, figuring out partnerships or opportunities that validate synergy in advance. Those are all things you can be doing that make a big difference. But let's also focus on private equity as another stage of M&A or next chapter for companies. Folks like FTV really like to have a relationship well in advance. So there is a courting process, and it should be a two-way courting process. Get to know the best possible prospective investors and let them get to know you, so that when a process actually starts, they're already getting up to speed on the market. They're already interested. They already respect you as a management team. So all those things get factored in. And I think if you give it the right time and energy and planning, there too, you can really extract incremental value when you do get to an exit.
Excellent. Okay, we're going to, in the last 2 minutes, we're going to give you 30 seconds each on, are you excited about the rest of 2025 and 26? And again, in 30 seconds, why? Luis?
Yes, very, very much so. And obviously a lot of it related to the topics we've been discussing. AI, the opportunities in the secondary space where I'm jumping in, and I am crossing my fingers for an overall stable macro environment, given that there's a ton of risks on the back of that, including some policy related.
Chris Lynch?
I'm super excited because I think that we're going to see consolidation. You're going to see a whole new ecosystem of buyers of technology companies that can leverage data across verticals. So from my perspective, AI it's overhyped. There's going to be, just like every other market, we've seen the advent of the internet, etc. But I think that there's going to be tremendous disruption. And for people that are bold and creative, there's going to be incredible opportunity for the second half of this year and well beyond.
Chris Conde?
I think this is the most exciting time. I've been in technology for a very long time. This is by far the most exciting time I've ever seen. The chance to reinvent yourself to reinvent your company, to reinvent your business model. That does not happen often. It is happening now.
That's called the joy of work. Brad?
Yeah, I mean, look, I'm excited about AI. I'm excited about the current environment in particular, though, because there's so much pent up demand for liquidity. And so we're seeing a lot of really interesting companies coming to market. We've already closed on 8 investments this year, and I see a strong pipeline of opportunity in the back half of this year. So continue to be excited about those opportunities to be the source of financing for the next chapter of growth for these interesting businesses.
Excellent. Well, thank you very much to the panel for today. Luis, Chris, and Brad, you've done an excellent job informing our listeners of what a scale-up company needs to think about as they're moving to the next stage and kind of where AI is going to impact them. We had said beforehand we weren't going to talk about AI. I think we tried to actually skirt it today, which was great because we did talk about the impact of AI on existing companies, which is something I think many people care about. So thanks again for your time. Have a great day, everybody, and we'll see you all soon. Cheers.
Thank you. Thank you all.
Thanks, Andy.